Hi everyone, I'm Andrew with Jesani Wealth Management, and the investment landscape has really become much easier for the average investor to either zero in on a specific sector or based on what they think is going to happen in the market over the next year in a specific sector to trade to make that trade, or alternatively to diversify a portfolio of real estate or a portfolio of blue chip stocks across. You can really do anything that you could possibly want to do with a lot of the tools and structures of the funds out there today, which is certainly a good thing for the average investor or the retail investor. Um, but certainly fees are associated with that because to create those products, there's managers behind them and they have to constantly keep them lucrative. So there's fees associated with that. Now, on the real basic side of things, as we all know, to trade stocks is fees are non-existent anymore. But I want to separate it into really two key categories because as a client, you're either going to work with one of these two. You're going to work with a registered representative, which is they work at a broker dealer. It's a broker or a stockbroker. They're registered with FINRA. Or you can work with a registered investment advisor. They work at an RIA, registered investment advisor, and that's a financial advisor or a fiduciary, meaning that they're legally bound to act in the best interest of their clients. Now, the big difference between the two is that a broker is collecting a commission based off of a transaction. So if a broker calls you and says you should buy 100 shares of Apple, they're charging you a 1-2% commission for that trade. So why anyone would pay a commission for a transaction these days is beyond me. But if you do that through a registered investment advisor, there's no commission whatsoever to make that transaction because a registered investment advisor is charging you, the client, a fee, usually about 1% per year, to manage those assets and to give you financial advice. So the only way that a registered investment advisor gets paid is that 1% annual fee that they get from a client. Now, with stocks in the scenario of the broker dealer, maybe you wouldn't buy stocks anymore at a broker dealer. Can't see why you would, but there's a lot of other financial instruments that are used today. And some of them we use in our multidimensional asset allocation strategy. So let's use like REITs as an example, real estate investment trusts. So let's use a private REIT, for example. I discussed those in my video on REITs. Usually they will have different share classes depending on how that particular order is being solicited. So what I mean by that is if a client goes to a broker dealer and says, I want to put $100,000 into this Blackstone REIT, the broker dealer will get a commission, usually anywhere between 3 and 5% for that transaction. And the investor will receive, for example, the A class of shares that carry a sales load and may have a dividend yield of 5%. Where if that same client went to a registered investment advisor, said, I want to put $100,000 into this fund, they would get a no sales load share class, which may pay a 6.5% yield. So the client will get a higher yield because the fund is not having to pay that upfront commission to the broker for the transaction. So most of the major funds have separate share classes like that. In fact, almost all of them do. They'll also have an institutional share class or the iShares, which is for even a little bit better yield for orders of $1 million or more. But also structured notes are kind of a similar philosophy. If you purchase let's say a structured note, again, on Apple that we're putting our clients in through a registered investment advisor, which is what we are, may pay 12% with a 40% barrier. While that same note, if the client purchased it through a broker dealer, may, with all other terms remaining the same, may get a yield of 9% because, again, that broker dealer is getting an upfront commission to put their client into that note. So the industry as a whole is really pushing more towards registered investment advisor because there's not that conflict of interest between the advisor or the broker and the client. Certainly, when you're motivated by a commission, a broker may not really be making recommendations based on what's truly best for the client, but more so that they're going to get a commission for soliciting that trade. Where a registered investment advisor, it doesn't matter what we put our client in, our fee is always going to be the same 1% from the client. So we're truly working for the client, and there's no ulterior motives to put anything in the account or make any transactions or trades other than what is best for the client long term, right? We want that portfolio of assets to grow because as the portfolio grows, that 1% annual fee becomes larger and larger. So regulatory reasons, a lot of the broker dealers are kind of going away and everything is leaning more towards registered investment advisors. And most folks out there, if not everyone, is going to recommend to an investor to use a registered investment advisor because there's not that conflict of interest. One thing that's kind of unfortunate also is that a lot of the major firms, talking about the biggest Wall Street firms or investment managers out there, are duly registered. So they're registered as a broker-dealer and as a registered investment advisor. So an advisor there may work for one client, for example, and sometimes or on some assets, they're working in the capacity or wearing the registered investment advisor hat, getting a fee. But at other times on specific funds, they may put on the other hat and say, I'm going to act as a broker on this transaction and then get a commission from that. And of course, not charge an annual fee on those assets. And it can be really confusing for a lot of clients because you don't know in what capacity your advisor or broker is acting and if they're truly acting in your best interest. So I would certainly recommend, if you're looking for an advisor, to choose a registered investment advisor because you know what your fee is going to be. It's just that 1%, and you know that they're recommending things based on your best interests. Now, some of the funds that registered investment advisors like us use do have other fees built into them that are paid to the managers of those funds. But let's go back to the REIT, the private REIT, for example, and let's say it pays a 5% dividend, and then you participate in growth, and since inception's averaged 11%. Well, anytime that we're talking about numbers like that, that's net of any fees that are paid to the managers of that fund. And a lot of times those fees are 1.25%, 1.5%, sometimes up to 2%, just to manage and keep that real estate lucrative that's in that portfolio. Real estate syndication is a little bit different. There's usually not an upfront commission, but there is a 1 to 2% annual management fee for the general partners to keep that deal lucrative. And then, of course, on the exit side of the transaction, there could be a preferred or a waterfall payout where maybe limited partners or investors get the first 8% in profits, and then any dollars left over that are split 80% to the investors and 20% to the general partners. All of them are a little bit different. The structure I just mentioned is pretty typical, but there may be a incentive for the fund managers to create a capital gain at the exit of the fund and share in a larger percentage of those profits. I'm sure you're familiar with hedge funds, the old 2% per year plus 20% of the profits. Private equity funds generally fit into that category. They'll get their annual management fee and then, of course, a higher bump up or payout if there's a capital gain at the end. But again, any returns or historical returns that are being quoted from an advisor are net of any fees that may be built into it to the fund managers. Private credit funds are the same way, except that in private credit funds, a lot of the fees are being generated from the borrowers. The fees are built into that loan, and then, of course, those fees are passed on in dividends to the investor. The other product that can have fees or not have fees is annuities. Now, I will say that I've never issued a variable annuity, they're typically only good for the advisor because they do have really high fees that go to the advisor or the broker. But in a fixed index annuity, let's use a scenario of an annuity where you get 50% of the upside of the S&P on the up years, and on the down years, of course, you get zero, right? The S&P is down 20%, you don't lose any money because a fixed index annuity is principal protected. But on the upside, you get 50% of the S&P. You'll have the option when you begin that annuity to either get 50% participation in the S&P and not pay any annual fee, or it's called a spread. A lot of times it's about 2%, or you could elect to get 70% of the upside of the S&P each year and go ahead and pay the 2% annual fee. So let's say you start an annuity and for the first 3 years, the S&P is down every year, and you chose the strategy where you were getting higher participation and willing to pay that 2% fee. Well, even though you don't lose any money when the index is down, you will still pay that 2% fee. So your account value could go down 2% if it's down every year. Of course, if the S&P goes up, you're getting much more participation at 70% versus if you had the no fee structure at 50%. So they really give the investor a lot of options. So you can have zero fees, or you can elect to pay fees, whatever structure that the client is more comfortable with, or whatever is going to return the lowest yield. You could make the argument on an annuity that since you're principal protected on the downside, and also it really depends on where we are in the market cycle. Right now, after coming off a pretty monumental 10-year bull market, we don't know that we're going to have a bunch of good years ahead of us again. So it might make more sense to get a little bit less upside potential without paying that 2% fee in case we do have some down years. So every scenario is a little bit different. Of course, it depends on the purpose of that investment, but certainly impossible to avoid fees. These days, they're built into almost all financial products. It's pretty simple working with a financial advisor. You know what your annual management fee is, and certainly if you ask the question on a particular fund that you own or that you're preparing to invest in, what fees are built into this, a financial advisor should have no problem explaining to you any kind of hidden fees that are built into it. Although, again, your return is being quoted net of fees. On the other hand, a broker-dealer may be a little bit more complicated for them to disclose the actual commission that you're paying, or it may be really obvious because you might buy $100,000 worth of stock and you get the trade confirm and you owe $104,000 to that broker. So that's because you're paying a commission simply for them to execute the transaction. So certainly if anyone has any questions about some of the fees in a lot of the funds that we use in our three-dimensional multi-asset allocation strategy, be more than happy to walk through them. Again, every product is a little bit different, so it's certainly a good question and an important question for the client to ask. So thanks, everyone. And I'm Andrew from Neil Jesani Wealth Management, and I can be reached at 954-800-8552. Take care.